Okay, hello everybody. My name is Caleb Pearson. I'm one of the advisors and owners here at Compass Financial Services. I wanted to thank you all for joining us today. We have our monthly educational events, and quite frankly, I've been looking forward to this one because it's something I deal with quite a bit as an advisor here and as a millennial. But today we're going to be talking about investing for the next generation and a little bit more specifically about millennials and investing and other financial concerns that millennials have. So it's a topic that I enjoy talking about because I talk about it a lot at work. So excited to present some information about that today. Joining me today, we have Dan Holtkamp. Dan works with JP Morgan, and he's been a great ally, great resource for us here as advisors. They have all kinds of really good resources, both for us as advisors and educational for our clients. And so this presentation comes from a couple of different resources they have, and it's really, really good information. So I'm excited to hear from Dan. He'll kind of get things kicked off here in a bit. And then we also have Alan Holstein. He's been here at Compass for a little over a year now. He was an intern before that, so it's fun to have him on our team. He's working towards becoming a full-fledged financial advisor, and he's passed some of his licensing and all of that fun stuff. And it's fun for me because I am no longer the youngest person in the office. So it's good to have someone younger than me in the office to bounce some ideas and thoughts off of as well. As a reminder, I think I put this in the email that I sent out, but this is being recorded, so if you want to watch it again or if you want to share it with somebody afterwards, I will send out a link to the YouTube video after it renders and I get it uploaded and everything. So feel free to pass that along. That'll be out on YouTube as well. So I'll send it to everybody who's registered for this event. And the last thing before we get started, there will be a Q&A at the end. We can't do it through the webinar, but if you want to email me or send a text to our office line here at 515-327-1020. I'll keep an eye on that and see if there's any questions that pop up during the presentation. So with that, I'm going to have Dan go ahead and get things kicked off and kind of just frame up the conversation a little bit for us. So Dan, go ahead.
Great. Thank you, Caleb. Thank you for the opportunity to be here. And thank you for everybody for taking some time here over the lunch hour to learn a little bit about this next generation of investing. So you want to go to the next slide, Caleb. Earlier when you were kicking it off as, actually one slide before that. There we go. Earlier when you were kicking it off, as you mentioned, you are a millennial. I noticed a little bit of, not questioning in that, but just a little bit of, I'm trying to think of the word, but a little bit unsure. And I think part of that is when we think about, whether there's older people on the call, or maybe it is more millennials or Gen Zers on the call, depending on who you talk to, the definition of millennials and their perception of millennials really can vary. And so this chart shows the many different generations in America going back to the early 1900s. And actually, the baby boomer generation in purple is actually the only truly defined generation by the Bureau of Labor Statistics. That's 1946 to 1964. All these other generations are more abstract. They're not exactly defined, but Pew Research defines millennials born between the years of 1981 and 1996. And then everybody after that, Gen Z. Now, when asked what Americans' views are of millennials, different connotations, stereotypes, and even words come to mind. For example, lazy, spoiled, young, and even some say they just live in their parents' basements. But believe it or not, that is not the true definition of millennials. If you look at the millennial population, born between 1981 and 96, typically very educated, higher than past generations. They feel empowered, confident, and tech savvy. That generation specifically, and even the Gen Z, depending on kind of where you were at in those generations, your views can vary based on political, social, and different economic factors. If you think about it, the millennial generation, really the first presidential election that I know I, as myself, remember as a millennial was the 2008 election, and that was very divided and very heated at that point in time. Also, many social factors like 9/11. Many millennials, were around during 9/11, of course, but also remember it vividly. Where Gen Zers, typically, again, born in 97 or after, they typically don't have a recollection of 9/11 and what happened then. And that impacts not only your views politically, economically, but also socially. And then finally, different economic factors, play into this as well. So a lot of millennials, started their, first real careers, after the 2008, 2009 financial crisis, or maybe, struggled to find a first good paying job because of what happened during the financial crisis. And so I think it's just important to kind of level set, who are these generations and what are some of the things to consider. So next page, please. This page looks at, on the right-hand side, some of the concerns and worries that millennials and Gen Zers have. And at the top right, you can see, probably no surprise to most of you that are on the Zoom here today, the shorter term factors are the most important factors to millennials today, which is, saving, not necessarily saving for retirement, but saving for an emergency fund, saving for that next new purchase, but also managing debt. Many millennials, as they'll talk about, took them a little while to get that first good paying job because of the financial crisis of 2008. And so managing debt, our top concern. At the bottom, you see things like insurance, taxes, investing. And while I think they're things that are all on all of our minds, I think these are longer term factors. And as a result, maybe not as top of mind and a worrisome factor for many millennials today. But when it comes to insurance, when it comes to investing, pushing that off too long could actually be one of the biggest risks of all. If you don't think about insurance, while many of us are young and healthy, I'm not an insurance expert, but we want to be thinking about that today while we can afford it and while we can get insurance, because you never know what happens, down the road. Same thing when it comes to investing, waiting too long, which I'm sure we'll talk about here in a few minutes. That power of compounding really can make a huge difference. So getting started early. And so there is a lot of things to be thinking about. So if you go to the next page, I think one of the biggest concerns for many millennials today is student loan debt. And so if you look at the left-hand side of this page, what this is showing, if we focus on the gray bars on the far left, this is people ages 35 and less, and it's the ratio of their income relative to prior generations. And you can see that today, all the other older generations have higher income relative to the 1980s, the blue bar, except this most recent generation. Again, those 35 and younger, essentially millennials. And I think a lot of that has to do with the fact that, many millennials went to college, put off working, and have had higher levels of debt to pay for that education, but also have delayed their early working years. And as a result, many of them have delayed investing until they've started to pay off some of that debt. And so I think it's a big thing to focus on. But also on the right-hand side, if you look at, the households with student loan debt today, again, millennials, 40% of millennials have some level of student loan debt, which, again, research shows that, going to college and paying student loans, typically you do receive higher incomes even after those costs. But that does have impacts when it comes to thinking about saving and preparing for retirement and thinking about investing. And so just wanted to kind of set the stage for who are millennials, what are some of the factors that are maybe top of mind, and then turn it over to Caleb and Alan to talk a little bit more about some of these factors in more detail.
Great, thanks, Dan. Yeah, so I'll start that conversation on digging in a little bit more on the saving and investment side of things. We all know that debt is definitely a burden for a lot of millennials. Student loan debt being a big chunk of that, but also credit cards, any other personal loans, those types of things. But as millennials, as your career continues to grow, and a lot of these topics, I should say, apply to all the generations, but we're specifically kind of talking about millennials kind of early in the career, things to be thinking about and all of that. But the goal is to continue to grow your net worth, right? And to grow your net worth, there's two things you can do. You can add assets or reduce liabilities, or a combination of the two, right? So the more assets you have, the more you save, the more investments you have, equity in a house, those types of things, that grows the asset side of the balance sheet and the net worth statement. And the goal as well is to be paying down or reducing the debt or the liabilities on the other side. So we want to see, the net worth being a higher percentage of the pre-tax family income, like we see in other generations, the longer you go into your career. And so today we won't talk a ton about paying down debt and strategies for that. We'll kind of touch on that a little bit, but I want to focus more on the saving and investing side of things. And Alan will dig a little bit more into the investing side as well when we get to him shortly here. So if I can get this, here we go. So to talk about the savings goals and investment goals, I like to think of it as like buckets. And I actually just recently wrote a blog about this. It's out on our website if you want to check it out. It was in our newsletter that's going out, I think today or tomorrow. But when you think about your savings goals as buckets, it allows you to think about it in a different way, in different risk budgets for the different buckets. Okay. So for shorter term goals, as you might expect, you don't want to take on a lot of risk. If you have, your cash reserves, your emergency reserves for the next 3 to 6 months worth of expenses, it's good to have that just sitting in cash and not taking on a lot of risk. I'll show you shortly here some of the pitfalls to that, but that is something that you want to consider. But the further out you go with these goals, if you have something 2 years from now or 5 years or 10 years from now, whether it's maybe paying for your kids' college or buying a house, or if you have an expense, you want to buy a boat at a certain age or something fun like that, but it's a big expense, but it's further out, you can then consider taking on a little bit more investment risk for those longer term goals, because you're likely to get a better rate of return the longer you invest and the more risk you take. So and then, of course, the long-term goal of retirement, that's the big one, right? You want to make sure that you're saving, you're putting some money into that bucket as well. And you have a little bit more of a risk budget there because it is such a longer-term goal. And I just like thinking about it in that framework, because it allows you to take on risks where you need to take on risks, and then not where you don't need to. The bottom graph here kind of shows different periods of time over 20 years, 10 years, 5 years, and what different asset classes have done over those periods. I won't get into the weeds on it too much, but basically the more risk you take, the better chance you have at having a higher return the longer that you stay invested. And so that's always something that we want to keep track of and think about. But this slide goes back to my point before about how having a little too much sitting in cash or in a savings account earning low interest can be a burden towards your longer term financial goals. This shows the different decades, the 80s, 90s, 2000s, 2010s, and 2020s, and what the inflation rates were and what a 6-month CD paid in those decades on average. So it'd be great if we were living in the 80s again, as far as interest rates go, because you'd be getting 10% on a 6-month CD, and inflation, headline inflation, was only 5.5%. So your real return, the difference between the interest rate you're earning and inflation, was 4.5% in that time period. But you can see the more recent we get, the lower the CD rates have gone. And now the 2020s so far, on average, a 6-month CD pays 0.3%. This is true for even like high yield savings accounts and those types of things. The interest rates have been so low and have been going down for so long that you're actually losing money if you're looking at real returns compared to inflation. And inflation is a word that, we haven't seen high inflation much as millennials since we've been alive, but the last few, the last year or so, we've seen inflation jump quite a bit. And so interest rates are going up a little bit, and slowly they'll likely keep going up here for a while, but it still is lower than what the inflation is. So I guess the point of this slide and the next one too is, yes, you want to protect your money. You don't want your money to go down, but if you have too much sitting there and you're not taking on risk for your longer term goals, then you're losing out. There's some opportunity costs there. And this, I think, is a great example of that. The gray bars is if you were to put $10,000 into a 6-month CD, earning around what we saw on the previous slide, versus the green bar, which is if you were to put that $10,000 into a 60-40 stock to bond portfolio. You can see over 10 years, 20, 30, 40, the difference in returns is very stark. You know, over 40 years, you can see the difference between if you just had the money sitting in the bank, earning a little bit of interest, it's not going down, but you're also not earning very much, versus taking on more risk and investing in a 60-40 portfolio. Every situation, every person is different. Some are comfortable taking on a lot of risk. Others don't want to take on much risk at all. And that's our job as financial advisors, is to kind of help you decide how much risk to take, what's a healthy amount of risk for your situation, what your goals are, and what investment mix and which buckets to be putting your savings into. I get this question all the time, is, okay, I'm, a few years into my career now, I have extra money every month and I'm wanting to put towards something. Where do I put it? Where do I put that extra dollar that I'm earning now in savings? Do I pay down debt? Do I do a combination of the two? And this slide, I think, does a good job of kind of framing up how to prioritize your savings. Again, everybody's situation is different. So you may have some of these options available to you, you may not. And that's where kind of sitting down and kind of mapping out your own personal goals and your own personal savings goals is a good idea. But this is a good general framework for you. So if you look at the bottom here, where it says start here, number 1, emergency reserves. It's a no-brainer, right? You want to have 3 to 6 months worth of living expenses. Sometimes people want more than that. Sometimes people are uncomfortable having even 3 months worth of reserves, but you need to figure out kind of what that number is for you, what that safety net looks like for you. And that money should just go, like I said before, into a savings account, high yield savings account. Maybe you can get a decent 12-month CD rate that's paying a little bit more. There's other types of avenues there where you can get a little bit of interest. But that's money that you don't want to put into something that's super risky. You don't want to put your emergency reserves into Bitcoin or an individual stock or something like that. This is something that you want to earmark for safety, and you don't want to take a lot of risk with it. But as you kind of move up this list, these are different ideas on what to do with those extra savings or those extra cash flow dollars that you have each month. So the next two, maximizing your employer match. So if you work at a company and they have an HSA match, a health savings account match, or a defined contribution, usually like a 401k or a simple IRA, something like that, where not only are you putting money in as the employee, but if they're matching those contributions, it's a good idea to put in at least as much to get the full match that you can get. Because if you think about it, if you put in, for every dollar you put in, you get another dollar, that's 100% return. And that's basically free money, because if you're putting it in anyways, you're getting that match. So we like to see people at least maximize whatever they put in to get the employer match on those two products or those two types of accounts. And then you can see the blue number 4. Then once you're done doing that, think about paying off higher interest loans. So they use the example here on this slide of 6.25%. You can kind of define it yourself, but if you have student loans that have a high interest rate, or if you have credit card debt, something like that, it's good to start getting those things paid down a little bit more quickly and having that, because we talk about the difference of what can you get in return in an investment account versus what you're paying in interest in debt. We like to say, if you feel like you can get a better return in investments, think about that. But we like to see those high interest rate debts going down too. And then the next four or 5 and 6, putting more money into your 401k, the HSA. Number 7, paying down lower interest debts. And then 8 and 9 are, kind of additional things. Maybe if you don't have a defined contribution plan, maybe consider opening an IRA or a Roth IRA to put money in for retirement. Number 9 is a taxable account. So I would use that, if you have a goal of something, 5 or 10 years out, it's going to be before retirement, but you still want to invest and put money in and invest it so you could hopefully get a decent return between now and when you need the money. A taxable account is a great option for that. So you can get money out of it when you're ready for it. But between now and when you need it, you can take on a little bit more investment risk. This one is another question we get quite a bit is, should I do traditional or pre-tax contributions, or should I do Roth or after-tax contributions? It all depends on what your tax rate is. If if your tax rate is going to increase over your working career, typically you can see this left-hand graph, you're likely to have more money when you get to retirement to take out tax-free if you do the Roth option. But if you think the tax rate's going to decrease over your working career and into retirement, then the pre-tax option works out mathematically better. What I tell my clients, and I've know other advisors say this too, but it's good to have different, again, buckets of money diversified by tax, right? So you have pre-tax money, you have Roth money, you have after-tax money, or the taxable account type money in the bank account and savings. Because what that allows you to do when you are in retirement is play the tax game a little bit and say, okay, I want to stay in this tax bracket. How can I do that from my different buckets and my different sources of income? So by having those options and having different types of tax treatment options available to you, you have some more flexibility there on the tax side of things. That is it for my piece of it, Alan. I'm going to have you take over here and kind of talk a little bit more about the benefits of starting early, and then chat a little bit about different investment strategies, diversification, that kind of stuff as well. So Alan, go right ahead, bud.
Thanks, Caleb. Some great information there. Before I dive into this slide, one thing that I always like to point out is the simple case of what are the ingredients when we talk about investing. And for me, the 3 ingredients to investing is time. How much time can we let it grow? The second one is, what are we investing in? And the third is, how much are we investing or saving? Because a lot of times you hear clients, as they get closer to retirement, making a lot of comments about that time ingredient, saying, I wish I had started earlier, or I had started earlier, but unfortunately, things happened in my 30s and 40s that caused me to stop investing, and I really wish I would have continued with that. And I think a lot of times time is the big ingredient discussed, because it's something that we can't buy more of, and we can't earn more of it. We can't get any more of it. And so the earlier that we can start saving and investing, the better we can use the power of time and have that on our side to take advantage of that compound interest. And so as we see in this graph, 4 different individuals, they all have the same savings rate. They're all contributing $200 a month. But the big differences is their time and consistency. We see that Lila in the purple, she didn't start until she was 35. Quincy, on the other hand, he started when he was 25, had a great track going ahead of him, but unfortunately, when he was 35, he stopped. And then we have Noah in the green there, and he's the person who didn't take a lot of focus on what he was investing in. He might have been a bit scared, but yet he was still consistent and still had the benefit of time on his side. Obviously, most people are going to look at this and say, I want to be Chloe. I want to be that blue line and have the most that I can at the end of retirement. Well, to do that, the best advice that we can give is to try and set up something systematic, something that's routine, where you're putting money away each month and buying into the same fund or multiple different funds and stocks each month. And then hopefully over time, that becomes muscle memory. It kind of happens in the background so you don't focus as much, and it helps take out a lot of the emotion that's usually tied up in starting and stopping investing. If we can kind of fix it and forget it and then assess things as we go, it's much easier than starting from scratch. Next one, Caleb. This is one that it's tied into our last slide, and it begs the question people always ask is, you know, this is what I make, and I'm really happy with my current lifestyle. And when I retire, say age 65 in this example, I want to have the same lifestyle in retirement that I currently have. And this table helps us estimate, for example, here, if you're making $60,000 currently, and you're age 35, and for one reason or another, you haven't started investing up until this point, roughly you'd have to put away about 10% of your income if your objective is to have your current lifestyle continue once you enter into retirement. What I like about this chart is it shows that if we didn't follow Chloe's example from the previous slide and start early, we don't have that time ingredient to do the heavy lifting. We can maximize the other two ingredients to still reach our retirement goals. So in this example, we're making up for any differences or reasons we might feel behind. We're making up for those losses with an increased savings rate. So again, if you're making $60,000 and maybe you didn't start at 35, but at age 45, you decide, I really need to start saving for investing. I acknowledge that I don't have as much of the time benefit as I could have had earlier, but I still want to reach my objective. And we can see here that that is an option. If you're in that category, instead of doing the 10%, it's estimated that you could put away 19% of your annual income and still get really close to hopefully meeting your retirement objectives. Next one, Caleb. This one has a lot of numbers, a lot of colors, but I really enjoy this one because as I have a lot of candid conversations with my peers, a lot of their questions involve, you know, what is your topic on cryptocurrency or whatever the hot buzzword, you know, stock or fund is. And I think a lot of times younger people are surprised to hear what I would say is the more mainstream, the tried and true, sometimes even the boring approach, and that is taking a diversified approach. I like to use the analogy of let's buy the entire dartboard or pieces of each of the dartboard versus just buying one section of the dartboard and hoping that when that dart's thrown, it sticks in that one section that we bought. And so we can see here, if we compare asset allocation, which is the white boxes there, let's compare that to small cap. We can see the annualized returns over this 14 or 15 year period, it's about a 2.6% difference. But if we compare the track that the white boxes took compared to the orange boxes, the roller coaster ride or the emotional journey of staying in the market for those 14 or 15 years was a lot more smooth through asset allocation. And if we're still reaching our retirement goals, whatever those may be, personally, I think it's much better to choose the asset allocation or the smoother ride. So we still reach our goals in the end, but hopefully across those 14 years, we have a lot more sleep at night and a lot more comfort. And we're not riding small caps. You know, sometimes they were the highest winners, but sometimes they're also the largest losers. And it's much more comfortable to stay in that middle ground. Next one. Thank you, Caleb. This one's really helpful, especially for younger generations. Some millennials might have had decent investment accounts when the 2008 Great Recession hit, but there's also a large portion of younger investors where they've only really felt the pain of a market downturn in the beginning of COVID and what we've seen this year. And so it's really easy to view the market and view investing in this over magnified, very narrow view. And this graph does a great job of helping us back out of that narrow view and say, what does history tell us? What can history tell us to hopefully reduce some of the emotion that we're feeling? And we can see with this graph that even though the average intra-year downturn was 14%, we still ended 32 out of the last 42 years with a positive annual return. And so it just reminds us, like we pointed out in the last few slides, to stay consistent, to stay for the long run. And history tells us that that will pay off in the end. And really, in terms of having a healthy and functioning market, these downturns that we see are a necessary thing to continue having a free and healthy market. This last slide I'm going to point out, I think it's one of the greatest temptations that younger investors have, and that is timing the market. We all wish that we had a crystal ball. We wish that we had done the best analysis and we could pinpoint exactly when the peak or a trough, the higher the low of the market is, so that we can catch 100% of the upswing. And as much as we can avoid this temptation, it's really going to benefit us in the long run. As we see in this chart, those blue dots show a shift in consumer sentiment. We can see the peaks at the top and the troughs at the bottom. And the number under each one of those blue dots shows what the S&P 500, also known as kind of the general market metric, what that did in the following 12 months after that trough. So for example, we see April 2020, during the COVID downturn, consumer sentiment hit its new low. And consumer sentiment meaning what is the general public, what are investors feeling? It's kind of the fear and greed. Are we confident in what's happening? Or are we very nervous and skittish and we're not very positive on our outlook? So in 2020, we had a very low, very pessimistic outlook. And if we had focused on our emotion and said, we need to pull, we're trying to time the market, we need to pull our money out of the stock market because this is just going to get worse, we would have lost that positive return of 43.6% that followed the remaining 12 months. And so as investors, when we look at a chart like this, how do we really apply this? And I think it's important to, over time, shift our focus and see these downturns in consumer sentiment as opportunities. It's opportunities to assess our current investment strategy, hopefully something that we've set up and have been doing for a while, but to assess it and make sure we have that diversified and that broad approach so that whatever sectors or areas recover, it's not a question of if they'll recover, but when. And we can't time when. And so let's just make sure that we have a broad approach and make sure that we're positioned well to catch that upswing whenever it may happen. And if we can shift to that more opportunity approach versus getting caught up in that consumer sentiment, history tells us, and like this chart shows, the next 12 months should give us some wonderful returns.
Great. Thanks for that, Alan. I believe that was the last slide for the presentation. So that being said, if you have any questions, I haven't seen any come in, but you can send them right now. I'll close things up here real quickly, but thank you for joining us today on this. Dan and Alan, thanks for your part in it as well. Really, the goal of this was just to give a general idea of what are some concerns that are out there for the millennial generation? What are millennials thinking about? What options are available? But at the end of the day, everybody's situation is a little bit different, right? Different debts, different kinds of debts, different types of investment accounts, different options through employers, all of that. And so really my encouraging words, I guess, are just to kind of sit down and come up with a game plan and think about what your goals are over the next 12 months, the next 3 years, 5 years, 10 years, and into retirement. It's never too early to start planning. And as Alan pointed out, the earlier you start, especially when it comes to investing and saving, the better off you can be. So I'd encourage you, if you haven't sat down and done some of these exercises and thought about what you want your money to do for you over the next 20, 30 years plus, I encourage you to start now, because that's very powerful the earlier you can get going on those types of things. So with that being said, I don't see any questions popping in, so we'll go ahead and end things here. Thank you again for joining us. Again, Dan and Alan, thank you for your help with this. If you have any questions that come up after let me know. And like I said before, I'll be sending out a recording of this presentation. So feel free to rewatch or share with anybody who you think might need it. And of course, if you have questions or you want to meet with one of the advisors here, feel free to reach out and we'd be happy to do that. Thank you.